Margaret Mueller. I'm the president and CEO of the Executives Club of Chicago. Welcome to Exec Club's 45th annual Economic Outlook. I know, pretty amazing. It's so fun to look out and see so many familiar faces, lots of new faces. Thank you all for being here to help us kick off 2025 in a really big way. Before we get started, I want to thank the sponsors of today's program. Special thanks to our annual Economic Outlook presenting sponsor, BMO Financial Group. I'd also like to thank our featured sponsors, as well as our spotlight sponsors. You can learn more about each of these organizations in the program at your seat. And finally, thank you to our Signature Series season sponsors. They are the ones that give us our support all year long. Now, I want to acknowledge the many members of the Exec Club Board of Directors and Board of Advisors who are here today. Some are seated here on the dais, others are seated at the tables with their guests. Either way, when you hear your name, please stand and remain standing, and please let's hold our applause as I work through this outstanding list. We're going to begin with the members of our boards and the special guests who are seated on the dais, starting with Mary Cook, Senior Managing Director, Korn Ferry; Ari Levy, Founder and CEO, Shift; Kristen Prince, Founder and Managing Partner, The Prince Law Firm; Nora Lark, CHRO, Wintrust Financial Corporation; Monica Turnbull, CHRO, HCSC; Melissa Conyers-Irvin, Treasurer, City of Chicago; Beth Marion, Senior Managing Director, Accenture; Karen Brennan, Global CFO, JLL; Joe Nelligan, CEO, Molex; JP Compt, President, Rana Meal Solutions; Mark Heckler, President, Chicago Region, Fifth Third Bank; Dr. Bob Froelich, Owner, Kane County Cougars; Diane Swonk, Chief Economist, KPMG; John Rogers Jr., Chairman and Co-CEO, Ariel Investments; Tim Line, CEO, Antares Capital; Roger Howell, CEO, Houlihan Capital; Dan Ryan, Managing Director, Mortensen Properties; Michael Fosnacht, President, Chicagoland and Chief Growth Officer, Clayco; Allison Borgmeyer, Chair, U.S. Food and Beverage, Edelman; Kimberly Evans, Executive Vice President, Northern Trust; Jessica Fairchild, Partner, Croak Fairchild, Duarte and Berries; Sandeep Nain, President and CEO, Essential; Tony Preckwinkle, President, Cook County Board; Jason Gandy, Senior Vice President, FCI Consulting, NTT Data; Julie Scott, President, CEO and Founder, CTS Impact; Linda Chapin, Executive Vice President and CHRO, UL; Tom Kuntz, CEO, United Healthcare; John Martin, Managing Principal, Victory Park Capital; Travis Hunter, Office Managing Partner, Chicago, KPMG; Natalie Brown, CEO, Mesero; Chris Shavink, President and CEO, Shure Incorporated and Exec Club Board Chair; Terry Savage Productions; David Hamflin, Global Vice Chair, Corporate Development, Kearney, and First Vice Chair, Exec Club Board; Teresa Wilton Harmon, Chicago Office Managing Partner, Sidley Austin, and Second Vice Chair, Exec Club Board; Mike Miranda, Head of Investments, North American Private Wealth, BMO; Imran Qureshi, Head of North America, WTW; Wendell Dallas, President and CEO, Nicor Gas; Kevin Cole, Chicago Office Managing Partner, EY; Melissa Tendick, President, Barilla Americas; Robert Seven, President, Chicago Region, Savills; Kara Burns-Pan, Regional Executive, Global Commercial Bank, Bank of America; and Daryl Hackett, U.S. CEO, BMO Financial Group. And please wait, seated in the audience, we have Sean Bieber, President and CEO, CIBC; Bob Frenzel, President, Commercial Banking, CIBC; and Dan Kutleroff, Chicago Office Leader, Mercer. You can now join me in thanking all of these leaders for their commitment to our mission. You may take your seats. Finally, I do want to ask the members of the Exec Club's Membership Council, our HERMAC Council, our DEIA Task Force, and the rest of the members in our audience to please stand so we can acknowledge you as well. You are an amazing group. Thank you all for being here. Thank you for your time and dedication that you give to the club. And of course, if you're not a member yet, we'd love to tell you more, so please stop by our membership table after the program for information on what we have to offer. And before I wrap, I also want to acknowledge the incredible team who has worked with me these past 6 years and who deliver programs like this day in and day out every week. They are incredible. You cannot believe how small and mighty this team is. I especially want to acknowledge Laura Wasserman and Megan Sykes, who are our fearless leaders for today, who just make it seem so easy. So please join me in welcoming and thanking the Exec Club staff. Okay, that's it for me. Please enjoy your lunches while we play a recap from last year's event. And in a few minutes, Mike Miranda from BMO Wealth Management will be back to kick off the program. Thank you.
Everyone, I'm Mike Miranda, Head of Investments for North America at BMO. Thank you all so much for joining us today. I'm happy to be here on behalf of my colleagues at BMO. As a top 10 bank with our headquarters right here in Chicago, BMO is proud to be an active member of the Chicago business community. We're committed to the economic success of our city and helping families, communities, and businesses make real financial progress. BMO values our sponsorship of this annual program, and we are grateful to the Executives Club for the partnership. Returning to speak at the annual Outlook this year are Dr. Bob Froelich, owner of the Kane County Cougars Baseball Club and former vice chairman at Deutsche Asset Management; Diane Swonk, chief economist at KPMG; John W. Rogers Jr., chairman and co-CEO of Ariel Investments. Now I'd like to introduce our panel's moderator, Terry Savage. The name Terry Savage is synonymous with the annual Executives Club Economic Forecast Luncheon. This year marks her 45th year at the helm. Terry needs little introduction to many of our regulars here, but in case you're new to the club and Chicago, Terry has written 4 best-selling books on personal finance and writes a nationally syndicated column for the Tribune Content Agency. She appears regularly on WGN Radio and WGN TV. And last year, Terry made national news. Her expose of Social Security mistakes resulted in a big change in clawback policy and more attention to an issue that just helped pass the Social Security Fairness Act. So, congratulations, Terry. We love the energy you bring to all you do, and we are all very excited to hear this year's forecast. Please join me in welcoming Terry Savage.
You had to remind them, didn't you? Thank you, Mike. 45 years. Whoa. Well, and it is the 45th year, and actually, when you think about it, an incredible year that has passed since we met here last year to forecast the economy and the markets. And the year ahead, well, it's going to be even tougher, I think, to forecast a lot of dramatic uncertainty when it comes to these predictions of what might happen in the future. A real challenge for our panelists. I'd like to just digress for one moment. We sit here talking about what the market will do, what interest rates will do, what some good ideas for your portfolio or business management will be. But I think we should just take a pause for 30 seconds and think about the horrendous situation and the wildfires in California, which, well, they talk about the billions and 100 billion upward financial costs, has just really more than priceless cost of devastating lives of families. So it gives us a little bit of perspective on our forecasts and the importance of them today. And I just think if we all collectively put some energy out there and send our good wishes and prayers to the people out there affected, that would be something we should do at the beginning anyway. So just a thought. Okay. So where were we a year ago? Since then, we've lived through a hotly contested presidential election between 2 of the least expected candidates at this time last year. No, wait a minute, not just Kamala. Wait, so soon you forgot about Nikki Haley and Ron DeSantis, who were at the top of everybody's list this time last year? Beyond politics, we had a lot of financial surprises last year. It turned out to be a second year of 24+% gains for the broad stock market. Bitcoin surpassed 100,000, and we wound up with a strong economy that avoided a much predicted recession. It was a year when artificial intelligence provided a boost to everything from stock market investing to automobile driving, from medical diagnoses to the phone in your hand. AI promises to change everything. And Bob led us to that thought, not just last year, but even the year before, when he introduced us to ChatGPT. But it was also a year last year, beyond artificial intelligence, it was loudly offset by natural stupidity. with public pronouncements that defied both science and logic by suggesting that perhaps the polio and measles vaccines are unnecessary, or that cats and dogs were at risk of being eaten by immigrants. In the year ahead, the financial markets, indeed all of us, will be challenged to sort out fact from fiction, react to new policies, regulatory change, and Fed decisions. And that makes it all the more important that you came back to the Executive Club Forecast Luncheon this year, because it turns out, as I look back, you would have done very well in following our forecasters' market analysis and investment suggestions had you taken their advice last January. So before we get any further, at the top of our program, here's a humongous salute to Dr. Bob. You saw that video. He took away our collective breath last year, Dow 44,000. You were out there, you heard it. We can't wait for your forecast this year. And I have bit my tongue to say, give me a hint. I don't even know if he's going to say it's going up or down, so we're waiting for that. That's why you're last on stage. I just want you to know. All right, before we do that, we need some perspective. So why don't you just take a look at these charts, and we'll look at where we were a year ago and see where we are today. Last year on the Dow, when Dr. Bob made that outrageous forecast, we were at 37,683. That was a gain of 13% from the previous year. And this year, this past year, during the year, the Dow posted another 13% of the gain. And last night it closed at 42,297. And that is about unchanged as I looked just a few minutes ago. But during the year, the Dow closed over 45,000 in mid-December. And guess what? The Dow was not the most spectacular performer of the year. But you'll see that in a moment. But first, since you all think it's so easy for our panelists to come up and make these predictions, we're going to do what we always do. We'll just see how good you are at forecasting. So as I look back on my notes last year, I asked higher or lower, and you were divided roughly 50-50 according to my notes. Which means half of you were losers, big losers. Okay. So, and nobody believed Dow 44,000. So let's see what your forecast is by a show of hands, and I'm only going to ask you higher next year or lower next year. So how many people think when we meet here next year, the Dow will be higher than, call it, 42,300? Higher. Whoa. Well, let me just check on lower. How many people think lower? Oh my gosh, I think that's 70-30. 70-30. I got to keep notes for next year. Uh-oh. I can't wait. All right. You know, one other thing I'd like to point out when we're talking about the market. The Dow had a good year. It was up 13%. But the S&P 500, okay, was up 23% in 2024. That was the index fund that's in every one of your 401k plans. You didn't have to beat the market. All you had to do was be the market, and you were up 24%. Last night, it backed off. It was over 6,000 during the year, 6,099, and last night it closed at 5836. It's about unchanged today. So the S&P, the broader market, highly influenced by more tech stocks, outperformed the Dow significantly. And I should just point out that if you really want to speculate, the NASDAQ composite was up 28.6% last year. So trading this year over 19,000 last night. Okay, as wild as the stock market was last year, it was actually the interest rate markets that turned in the most interesting performance. You just heard in the video that many people were expecting 6 to 8 rate cuts by the Fed starting in spring. Well, it turned out we only had 4 cuts, and they started in September. Remember that 50 basis point cut? So here's a chart of the 10-year Treasury note, and this is a 1-year chart. Last year at this time, the yield was 4.02%. This year, when I did this last night, it was 4.77. It's 4.8 when I just looked. You will see the most interesting thing is that the dip in October was right after the Fed cut short rates. But ever since the Fed started cutting short rates, which is done 100 basis points, long-term 10-year bonds, the basis, by the way, for your mortgage rates, are up a full percentage point. So the Fed may control short-term rates, but obviously not long-term rates. Oh, you think you want to forecast rates? Okay. How many people, let's just call it 4 3/4, just to make it easy, the 10-year Treasury. How many people think the yield on the 10-year Treasury will be higher at the end of this year than 4 3/4? Okay, how many people think it will be lower than 4 3/4? Some people don't want to vote. Okay, but I'm just going to write down 80% higher. Okay. Inflation, that's been the big buzzword. So let me quickly show you just 3 charts just to get a picture of this. This is inflation, the consumer price index. Will get another reading tomorrow. But as you can see, for this is just 1 year. So as you can see, going back to early summer, June, inflation has been under 3% on a quarterly basis, the CPI, well under 3%. Now, where the Fed wants it. Now let's take a longer look. This is a 10-year chart. And you see during the pandemic, the peak of inflation at over 9%. But you can see that it's been, the Fed's pretty happy, well, I'll ask Diane, think that it's fairly well under control, at least down under 3%. So what is all this talk about inflation? I think this is the chart that tells the real story, though, because this is the CPI, the actual index over the last 10 years. And the top right is the price people are paying for stuff, whether it's their auto insurance, their homeowner's insurance, a new car, gasoline, and so forth. And people notice that prices are dramatically higher than they were 10 years ago or even 6 or 7 years ago. And that's the reason the inflation keeps making the headline news. What about a recession? There was so much talk about recession last year, actually even the year before. It was coming, it was coming, it was around the corner. But look, for every quarter, and this goes back over the last 2 years, GDP was positive. We have not had a recession. In fact, let me lengthen this chart to 5 years. The stuff on the left is the pandemic, the shutdown, and then the rebound. But ever since then, we've had positive GDP, around 2.5%, 3%. And certainly beating the rest of the world. Okay, one more thing. Oh, John, you're going to take it this year. I know you don't think it's a thing, but the market thought it was a thing. Bitcoin is up 120% this year. It reached a high of 106,000 on December 16th. And it is today, last night it closed at 94,224. A few minutes ago, it was up a couple thousand at 96,350. What is it? Is it something we need to think about for investment portfolios this year? Well, finally, it's time to get our panelists' forecast. So here's what we're going to ask. The Dow Jones Industrial Average, where will it be next year at this time? The S&P 500, not because just to find out, I'm going to ask you if you'll outperform the Dow again, is what I really want to ask you. The 10-year Treasury rate next year at this time, inflation at year end, recession or not in 2025, and do you have an economic wild card that you want to say that, I mean, it's a very uncertain year with a new administration, but what do you want to say that could be the wild card that could change your forecast? I'm going to ask you to forecast Bitcoin again just because we're all interested. And then at the end of the Q&A, I will ask my ever and favorite question, what would you do with $100,000? So let's get started. And let's get started with Diane Swonk. Diane, you're our leadoff batter for many, many, many years. I won't embarrass you. I don't even know how many, but it's been a long time. And you always entertain us. Diane is chief economist at KPMG, where she heads up a team that serves clients and partners. Diane's bio is so long that it would take up all of her time. The National Economic Council, briefs of Federal Reserve banks and the Board of Governors, congressional testimony. Look, if you don't see all that, for sure you see Diane on CNBC and on Bloomberg. Last Friday when they did the jobs report that moved the markets, there was Diane analyzing it. Last year, Diane forecast a soft landing for the economy and no recession, and that inflation would remain low. She feared the upcoming election last year would create uncertainty and perhaps a slowdown, bringing GDP down to 1.3%. That's a bit below what actually happened. Diane correctly predicted the Fed would cut 4 times, though her predicted May cut was delayed till September. She did warn us that the Fed would be exceedingly cautious to avoid another big mistake. Rates have been a bit higher than Diane predicted. She thought 3 to 4% range for the 10-year Treasury. We're above that now. And what did she do? Diane always ducks this question. She makes up some firm policy that says she can't tell you what she'd invest in. So last year, she handed her $100,000 investment to John. So we will defer analysis on the wisdom of that move until we double check John's performance in a minute. But right now, Diane, we're looking forward to your forecast for the year ahead.
I feel so tall up here. Well, you set me up well, Terry, because the theme of my comments today are something that I saw on a trip that I took with my husband. I don't take enough vacations. It's my own high-strung problem. But we were in London, and when you get onto the train, there's a sign that says, "Mind the gap." And that's around the world, actually. They have, they're worried about on the platform and you might fall in. Of course, I usually don't mind the gap, as my husband was trying to make sure that I didn't get hit with cars going in the wrong direction and looking the wrong direction. But I have a spatial issue. I'm not really good at driving either. I tend to only hit inanimate objects now. I've gotten better. I used to hit animate objects. But I'm so afraid of hitting my husband's new car. I don't know why he thought he needed a Porsche, really. I told him he didn't need it. But anyways, I hit the garage every once in a while. The mic is low, they tell me. Okay, so mind the gap. Phrase resonated because my comments on the economy today deal with the fact that we live in a world of contradictions. The economy adds up on paper to look phenomenal, yet the overwhelming majority of Americans do not feel that way about the economy. Now, some of our perceptions are distorted by the lens through which we look, through partisan lens. The minute an election happens, if your person that you voted for is in the White House, literally overnight, your optimism on the economy flips to be more optimistic if it is your candidate, less optimistic if it isn't. Nothing in the economy, even the pandemic, changes that rapidly. But consumer expectations do. It's important because what we've seen is the perceptions and those partisan divides are really just a symptom of something deeper going on in the US economy. We've seen a decoupling of confidence and the overall economic data for the better part of the last 24 years. There's reasons for that. The largest one is rising inequality and inflation. And I'm going to get into why. What we saw is nearly 5 decades of decelerating inflation, but rising inequality, with a brief break in the latter part of the 1990s, when we actually saw income inequalities narrow and consumer sentiment, as measured by the University of Michigan, hit a record high in January of 2000. That was coming off the glow still of the tech bubble of the 1990s, and at the time, the longest boom of the post-World War II expansion in period. It also was coming on the tail end of what we thought was an existential crisis, something called Y2K. Those of you who don't know what that is, you can ChatGPT it, but check the citations to make sure they're accurate. It's important because since 2001, we've seen the combination of economic integration and offshoring lower prices to the point of almost flirting with deflation at times, although at a price. And the price was it displaced a lot of workers. Even as new jobs were created, those who got displaced became scarred. This is like the arc of my life growing up in the Detroit area in the 1970s and coming back to where we are today. 2008 and 2009 global financial crisis added insult to injury because we struggled to recover, wages stagnated, and it took nearly a decade to finally feel as though we were healing, and then the pandemic hit. And upon reopening, wages were leveled up, and workers that were in the shadows of the economy moved out into the sun, only to be burned by inflation. It's important. It doesn't matter what the causes are of inflation. What most people believe is wages they got leveled up were earned and owed, understandably so. Inflation is seen as nefarious as a result of two things: government mismanagement and corporate greed. It doesn't matter what kind of chip crisis we had. It doesn't matter that Taiwan was in a drought and you need water to produce chips. It doesn't matter why we had inflation or too much stimulus in the uncertainty of those dark hours of the pandemic. What matters is it burns. And it's something I know very much about. It's like cancer. If you don't treat it, even though the treatment hurts, it can metastasize and become something much more systemic. What's important is, even though, as Terry very accurately pointed out, the pace of inflation has slowed, the level of prices are still staggeringly high for the most basic of things like food and shelter. Affordability in the housing market is at a record low. We do not have double-digit interest rates like we did in the early 1980s, but it's at a record low because of the increase in home values, shortages, because of the increase in real estate taxes that followed that, because of the increase in insurance costs, and because of rates. All of those together have made it so that the average age now of a first-time buyer is 38 years old, which is older than most millennials. That's the oldest on record. It's no wonder they're angry, because they're not able to achieve the same milestones the generations before them had achieved. And the heartbreak and devastation of what we're seeing in California and what we saw with two back-to-back monster hurricanes in September and early October make that situation even worse. Now, men, millennials, about 20% of them are still living with their parents. I asked my son about this because people aren't coupling anymore. And it could explain some of the birth rates being lower. But men break up with women for one reason, main reason, weight gain. It's true. Women break up with men for one reason, their politics. And I asked my son, I said, now he's living with his girlfriend, we like her. Here in Bucktown, even close. They're getting married, I love them. Maddie's still engaged, long engagements are good. But Griffin, I asked him, I said, what's going on? Because he gets on the dark web and he pokes the bear. And I said, did they just go in the basement and not come up? He goes, pretty much, Mom. They really just need a shower. But it is an issue. That said, it's important to understand where we are. Now we've got a lot of policy changes coming. The level of inflation is still high, and the Fed's battle against inflation is not yet over. Policy is still technically in restrictive territory, and whatever the Fed doesn't do, the bond market will clearly do for it. It's important because we don't have the slack we did back in 2019. Even though the labor market had improved dramatically, even though we had had 10 years of healing, we could still withstand tariffs and things like that without it triggering inflation. Now, supply chains, ironically, to escape tariffs and geopolitical risks are longer and more vulnerable to external shocks than they once were. That's important when we think about the context of understanding whether or not inflation can completely be contained this year. The dissonance that we're seeing is revealed in the economic data. It's as clear as one can see. Employment at the end of 2024 ended on a high note. Now, 1 month does not a trend make, but unemployment rate fell down to 4.1%. The ranks of those on long-term unemployed declined a bit, although they're still above where they were a year ago, and there's a soft underbelly there of those who lost a job are now taking longer to find a job than they did just a year ago. We also saw, though, in those same numbers that were taken in the middle of the month of December, not during the holiday week, record number of people not at work because they were on vacation in mid-December. Now that's on top of what was a record travel season for the holiday season. Between December 21st and January 1st, we saw 30.8 million people fly, a new record, according to the TSA. AAA estimates 107 million people went more than 50 miles to drive during the holiday season. And on top of it, cruises are back. Could knock me over with a feather. Up 20% last year, and bookings for 2025 up 10 to 15% already. So some momentum carrying us in. People are going on vacation, they should be feeling good. Early credit card data for the month of December suggests that we spent. We came out, we didn't do it until December because there was a compressed holiday season, but we spent online, on experiences, on things that make us feel good, discretionary things. That's important. We also saw vehicle sales in the month of December hit their highest level since May 2021. That is the peak before the chip shortages. When we all tried to buy cars, I keep the same. I only have 20,000 miles on my 2018 car. There's a reason I don't drive, as you already know. Ubers are great. But that's important. Highest level since May 2021 before we ran out of chips to produce cars. Some of that was clearly in response to the hurricanes and the damages. And the drain in wealth. Wealth actually took a hit from the devastation to homes, and that's before we get to the epic fires and the Armageddon that we're seeing in Los Angeles. This very same time, confidence in the economy, the Consumer Conference Board, measure of confidence, bumped up in November, got a little bit of an election bump, and then plummeted in December. Now, the Conference Board index is more sensitive to the job market. And it actually said people were feeling more leery about the job market, even though we got a good employment report. Maybe it's only 1 month, and then 1 month does not a trend make, or maybe there's a soft underbelly under there that we're missing. But that's important. Consumer sentiment by the University of Michigan, my alma mater, Terry's alma mater. The University of Michigan Sentiment Index, we saw that plummet in the month of December after moving up. We saw it plummet again on Friday for early January. What did it plummet on? People's expectations of inflation moved up, the exact opposite of what the Federal Reserve would like to see right now. And the number of people who said they were buying ahead of price hikes, including tariffs, dwarfed anything we saw during the onset of the trade war with China in 2018. That's important because there's a self-fulfilling prophecy of people hoarding. And some of those vehicle sales may in fact be related to people buying ahead of what they fear to be tariffs as well. Now, for the Federal Reserve, it is worrisome, these self-feeding things. There's a gap also as we look at it, and the Fed has to, they will not front run any policy shifts. They will react to them after they see them and after they see their effect on the economy. And that's important. And there's, of course, a wide spectrum. Now, at one point in time, I was thinking, you know, given what they're talking about with tips, Travis, I'm hoping you can help me here. I think if we don't tax tips, I think that I should be paid in tips. And I'm just, you know, it seems like I was a waitress, I was a hostess, I did this once, you know. I'm happy to be paid in tips. It'd just be a very large one, just so you know. I'll get to them. It's important because as we look at what the president promised on the campaign trail and what will be enacted, it's hard to determine how much we're going to see. There is something what sounds good on the campaign trail and plays into people's fears about an economy that they feel left behind may not translate well into policy. I'm an economist, and this is a perspective of an economist. There's something really base and primal about the desire to pull in and to be more protectionist and to isolate ourselves. The pandemic only amplified those feelings, and that's really important to understand as well. That said, the challenge is ensuring that as we try to right the ship for those who were hardest hit by the inflation and the lingering high price levels, they are the most at risk of being hit by tariffs and curbs on immigration. And I want to tell you why. Tariffs are a tax, a regressive tax. They hit low and middle income households harder. They do protect industries, but they never deliver in the research the investment in those industries to offset the pain they induce on consumers. That's just what the economics tells us. Immigration, we want secure borders. Of course we want secure borders. There needs to be immigration reform. But immigration, it's not a zero-sum game. It was a big part of the Federal Reserve's narrative on a soft landing because we saw job openings soar as the economy reopened far beyond anything that we saw before that, or we could supply with the workers in our own economy. The influx of immigration helped to fill vacancies on jobs native-born do not fill. That was a major shift. And in fact, research done by Brookings shows that the rise in participation driven by foreign-born, which participated at a higher rate than native-born, increased the participation rate of all native-born as well in prime age, including those men in the basement that are still living with their parents. That is something we want to have. Without it, you have much more acute labor shortages, particularly in agriculture, leisure and hospitality, and construction. The most dependent on immigrant labor. In fact, farmers have already asked for a waiver so they can have people to pick their crops. What we know is that rhetoric alone can be chilling, and we saw legal and illegal immigration fall precipitously during the last term of this president. That's important. The path down on inflation has been much more bumpy and much less rapid than the path up. I think we will get some improvement, although PPI numbers today, I gotta throw this in, largest increase in airfares on record. Now I know this personally because my daughter does not buy her tickets from the cheapest airline out there to come back from New York during the holiday season until 2 days before, and I saw $850 show up on my charge card. LaGuardia to Chicago. I'm like, when did you make that? She goes, yesterday. And I said, and when are you coming in? Tomorrow. That's how much notice I got. I knew she would be there, but nonetheless, I digress. We did make it to the Taylor Swift concert, by the way, and we did take over the men's room. They invited us, so it was fine. There are a lot more women there than men. It's important to understand tariffs take time to take effect. There will be some bumpiness in the CPI numbers as they come out this week, and the Fed's preferred index of PCE measure due to that airline fares is a pretty big number. That said, year-on-year comparisons as we get into January and February are going to improve quite a bit. I worry about the residual effect of the strain on resources of rebuilding what's happening in Los Angeles. But in the near term, we could get an improvement in inflation that may open the window for what I hope to be 2 rate cuts this year that would still keep monetary policy in restrictive territory. It's a stretch, but I hope that that's going to be the case.
Where will the 10-year be?
The 10-year is
At your end.
probably around 4.5, but
And where will inflation be at your end?
so I think inflation, we have modeled 3 scenarios, and a China trade war with some limited tariffs gets us to an 8% effective tariff rate up from 3, and that gives us a little over 3%, 3.4% inflation on CPI by year end. Now we'll get some decline in energy prices as we get increased production and frankly weak global growth, but we are seeing a floor form under the Treasury bond market, and that is due to the fact that we're issuing a lot of debt. There are concerns about inflation and tariffs, and we also have central banks no longer buying Treasury bonds like they once did, including the Federal Reserve. And all of that has put upward pressure. And I'm going to end on a personal note.
Wait, don't end. Wait, don't end. What about a recession next year? I got to fill my chart. I keep these charts.
2025, no recession.
Recession?
I have 2% growth after 2.7% in 2024. That's annual growth, fourth quarter, 1.8%.
Sorry, fourth quarter?
1.8, but 2% annual growth.
Okay, but 4.8 by the end of the year?
No, 1.8.
1.8, I'm sorry.
Is the, fourth quarter.
Oh, wait, you forgot to talk about the Dow.
I'll get to that in a minute.
Will you? Okay.
I promise.
I thought you were
I will
saying
do
you
it on your Q&A, but
All right,
let me
all right,
end.
okay.
I'm not allowed to end on my big finale.
All right, go to your finale.
I'm taking more of my time, and I need to leave time for Dr. Bob and everyone else, but I want to end on a personal note. The dissonance that we've seen in the economy over the last 2 years really, where there's a difference in how we feel about things versus how the economy has actually performed, is personal to me. In the last 3 months, I have lost a lot of friends and family members. And it's been a very difficult time. Ages in their 20s to their 90s. And many of my friends, close friends in this room, have lost people very close to them very recently. I found myself running out of time to go to all of the memorial services and the funerals. But in doing that, showing up, what I realized was, in our grief, we were united. It didn't matter who voted for who in the room. And in that, there is a united view of our lives. We were celebrating the lives of the people we love in this world. And that is something incredibly poignant to be able to be in a room and do, regardless of what your ideologies or your political affiliation. I stand here today. My dad passed in 2018, and I think about him every single day. Our relationship was complex. But I truly believe I'm standing on his shoulders in front of you today as I mourned a lot of people that I lost this year. And I believe we take what's good in those that we love the most in this world, and in that, we pay it forward and we keep their spirit alive. And I think that's what we need to lean into, is what unites us rather than what divides us in a world that has so much dissonance. Thank you. So you want my numbers?
That was some finale.
I'm sorry. Well, you wanted the numbers,
Oh,
right?
are you going to give me numbers now?
You wanted numbers. I
Yeah.
got numbers.
Okay,
I don't know
well,
how good they are,
All right,
but
what
you know.
numbers? Dow.
The Dow, 41,000.
Okay. Will the S&P outperform the Dow this year like it did, this coming year as it has in the last 2 years?
A lot depend, I don't know, obviously, but 40% of profits are from abroad. So if you get a lot of tariffs, that changes the equation quite a bit.
Oh, okay. I'll get your wild card later.
Unemployment rate, 4.3.
Oh, I didn't put that in here. Okay, unemployment 4.3?
Yeah.
That's not bad.
No, that's the benign scenario.
All right, the malignant scenario will come out in Q&A. Okay. First, though, let's go to John. Okay. Well, we are very delighted to welcome back John Rogers, Chairman and co-CEO of Ariel Capital Management, which he founded in 1983, the first black-owned investment firm in the United States. I repeat that every year because it just, I remember interviewing you on Channel 2 or 5, something like that, right when it started. It was a big deal. Their flagship fund, the Ariel Fund, is the only small mid-cap fund in the U.S. today that dates back to 1986. They all get merged out when they have bad records. You have not only survived but prospered. And John is known as a very patient investor with a long-term focus on value in mid-cap and smaller companies. We're not the only ones, by the way, who look to John for a forecast. You should check out the Barron's Roundtable in January, where he performs with all the luminaries of the financial world. Now, the Ariel Fund, which invests in small and mid-cap undervalued companies, was trading around $65 a share when we met last year and traded as high as nearly $85 in December. It's fallen back like a lot of stuff recently. That was his pick for $100,000, which Diane obviously invested in. I hope you just don't talk about it, put your money in there. But there was a carve-out John mentioned last year. He named a stock. Couldn't imagine why he named Madison Square Garden at a Chicago investment meeting, but it was then trading at $176 a share. It was a huge winner, moving up to nearly $240 a share. It too has fallen back recently. So Diane, you would have done pretty well. Last year, John strongly felt there would be no recession in 2024. And you do remember that the recession was widely expected at the start of last year. He predicted 3 Fed rate cuts starting in summer. His forecast of 3% on the 10-year Treasury was a little too optimistic, as was his outlook for inflation getting down to 2.5%. But I think probably, as you noticed in the video, the most memorable thing, aside from your good performance record, was that you didn't think Bitcoin was a thing that last year. For sure, if you don't mention it now, John, I'm going to ask you later, but I will turn the podium over to you for this year's forecast.
Well, thank you so much, everyone, and thank you, Terry. We have been friends now for this, 42 years or so. It's just crazy how time really does fly. And I think you look exactly the same, so it's just amazing, amazing. When I started the company, I always believed that the stock market was efficient and believed that it was very, very unpredictable. And I still believe that. I think the markets are very efficient and very, very unpredictable. But one thing I also have learned over this 42 years is how humbling a business it is. Last year I said the S&P was going to be down substantially, and again, Bitcoin would be down, and I was completely wrong. So I was kind of hoping I wouldn't be invited back and have to admit this but I'm back. I appreciate the opportunity. And really what I want to do today is to reiterate some of the themes that I talked about last year, because the year did go fast. There was lots of extraordinary amounts of drama that have already been talked about. But I do believe that large cap growth stocks continue to be extremely, extremely expensive versus small cap value stocks. And the gap has just gotten larger and larger and larger. So you can see that I'm going to double down today on this theme, and I'll give you some data and some ideas around why we think it's finally time for small cap value to have its day in the sun versus large cap growth stocks. But always, as always, I start with the caveat. We are long-term investors, as Terry said. Our logo continues to be a tortoise to remind people that Aesop's fable that the tortoise does beat the hare at the end, and slow and steady wins the race. We're also heavily influenced by Warren Buffett. And as you know, Warren always talks about the importance of long-term investing, trying not to be an active trader. And he always reminds us every year at the annual meeting that the Dow Jones started last century at 66 and it ended at over 11,000. And if you think about it, we all know this, but there was a pandemic last century. We had 2 world wars, the Korean War, the war in Vietnam. We had presidents shot and assassinated. We had 1968. We had the Great Depression and many, many recessions. I could go on and on. But as Warren always reminds us, and we have to especially be reminded this year, our capitalist democracy is the best system ever invented. And we find a way to get back on track no matter what the challenges this great country faces. So I continue to be optimistic long term, even with the sort of pessimism I have about the broader market and the S&P today. As Terry mentioned, the last 2 years have been kind of unprecedented, with the S&P up over 20%, 2 years in a row. And if you look at the Russell 1000 Growth Index, it has outperformed the value index by 63% over 2 years. That represents the largest gap since the index inception in 1978, including the tech bubble, which many of us remember going back at the turn of the century. At the end of the year, large cap growth stocks were selling at almost 29 times next year's earnings, very expensive versus historical averages, and very, very expensive versus small cap value stocks that were selling at just under 17 times next year's earnings. And the Magnificent Seven that we've all heard so much about and it evolves was selling at over 42 times earnings at the end of the year. And if you think about it, back in the early 70s, we had the Nifty 50 and the one decision stocks. They were just selling at 36 times next year's earnings, cheaper than where the market is today. Everyone feels this enormous pressure to own those 7 large stocks. They have to feel like they're part of the index, especially all of us professional investors. You don't want to be out of sync with the index. You don't want to have too much volatility. So there's a pressure. But when I've found that every time there's a pressure to own stocks just because they're a part of an index, that usually is a sign of a sign of trouble. So it really does feel to me a lot today like I felt during the internet bubble. I was during the Nifty 50 of the 70s, I was in high school, so I didn't experience that. But again, it just had that same kind of a feeling. People have this sense that markets are always going to recover and go up and up and up. You saw the optimism in the room today. When you watch CNBC, you see the optimism. Everywhere I go, I see the optimism. And anecdotally, it happens. I go out and talk to, like I did last night, to University of Chicago Business School students, and the amount of confidence they all have in their Bitcoin holdings and in their technology stocks. Everyone's gotten quite confident. I was at a Bears game recently, and there was a proud dad pointing out his son who had just made $1 million in MicroStrategy options. Another sign that there's a lot of over-optimism out in the marketplace. Friends and family coming up and bragging about their 401k balances now. I've really never seen that in a long time. And we all know, when the shoeshine boy was telling Joe Kennedy it was time to buy stocks in the early 20s, he knew that market was headed for a fall. The only example where I feel guilty is that when my pizza delivery guy from Geno's came to talk to me when he was delivering the pizza, he wanted to buy Bitcoin. And I feel extremely guilty that I told him not to. So how can it look when bubbles burst? So how bad can it get? You go back again to the early 70s, people forget that McDonald's was selling at 82 times earnings, Disney at 84 times earnings, Coke at 47 times earnings. They all declined between 60 and 90%, and all had single-digit PE ratios. We've gotten so comfortable with these 30 to 40 times PEs, we can't imagine a single-digit PE multiple again. But it could happen. And then, of course, we all remember when, in 2000, when the internet bubble did finally burst, the S&P 500 dropped 42%. Now, as we look at history, as I'm looking toward the future, it's also important to look at history, I think, at times. And the University of Chicago has their CRISP data. It comes from the Center for Research and Security Prices. And many of you know that Professors Ibbotson and Sunfeld found that between 1926 until today, small stocks have outperformed large cap stocks substantially, 11.8% versus 10.4%. And Fama and French, two other great professors, have worked since data from 1928 till today, showing how value stocks have outperformed growth stocks by over 4.5% annualized. So even after this great run for bull markets, this great bull market, this great historical upward trend in large cap growth stocks, still the data shows in the long run, value works and small stocks work. When you do the work in smaller companies, you buy things that are out of favor, in the long run, they really, truly do work. And then finally, when the shift comes, it can be dramatic. In 2000, when the internet bubble had finally burst, as I mentioned earlier, and the recovery coming out of it, the Russell 2000 growth index was down 19%, while the Russell 2000 value was up 47%. And that's pretty dramatic. People forget the difference that can occur in those types of periods. And I would expect to have the same type of outperformance coming forward. As people start to look and realize how expensive these companies are, they can't grow the sky. You're going to have new competitors coming into the high flyers. Things cannot be perfect forever. And these, as Warren Buffett often says, you pay a high price for a cheery consensus. And so I think right now, if you have the courage and the guts to go in there and buy these smaller stocks that are neglected and misunderstood, you'll get great returns over the next several years. And it'll be a good time to get a little bit of away from the large cap growth stocks that dominate the S&P 500 so dramatically. So thanks so much. It's been great to be here, and look forward to Terry's questions.
Okay, but wait. Yeah. I was there. That's a sobering reminder. I do remember the Nifty 50. Okay. I want to ask you in the Q&A about finding those smaller companies. Remind me to ask you of how you discern between the smaller companies that make it through and score and the ones that don't make it and don't last. That's your job, I guess. But
Yes.
First of all, you have to forecast a little bit for us. So are you bearish on the Dow this year?
Yes. I think the Dow will be down 10 to 12%.
Okay. That's not really even a bear market. Okay. Do you think the S&P will be down? It's been up for a couple of years, significantly more than the Dow. So I mean, what I'm asking is, will the broader market, the S&P 500, is still large cap, be down more than the Dow?
I think so. I think the S&P 500 has become a large cap growth index with the NVIDIAs and the other large cap growth stocks. And because they're so expensive, I wouldn't be surprised to see the S&P down close to 20% this year after 2 years of great outperformance.
Okay. Oh, Dr. Bob, you better rescue us. Wait. What about interest rates? 10-year Treasury at year end. We're about 4 3/4, let's call it right now.
I would think we would be closer to 4%. It's kind of where we're at these days. And it's been surprising, as we all know, what's happened with interest rates.
Does that imply inflation coming down?
I do think inflation's coming down, and anticipates your question around the recession. I think we're finally in a position where we could have a short and small recession as we get toward the end of the year, and that would help keep rates under control and inflation under control.
Okay. I'm not going to hit you with Bitcoin now and your investments and your wild card. Let us say thank you very, very much for that forecast. It was a little bit sobering. Dr. Bob, I'm not even going to take 1 minute. I I hope you're bullish, just because I was a little depressed just now. Everybody knows Dr. Bob. Dr. Bob knocked it out of the ballpark for the last few years. Please take the podium and tell us what you think this year. Thank you.
Thank you, Terry, for that very kind introduction. It does remind me a little bit like of the cover story jinx, you know, like John is so articulated Barron's. If you're ever like in the investment world and you're on the cover of Barron's, your forecast then will be completely wrong for the next 12 months. That's sort of the way it works. And, you know, from a sports perspective, if you're ever the cover story at Sports Illustrated, you won't win another game, you know, sort of the rest of the year. So with all the kind remarks that were deeply touching to me, I also think, as a word of advice to you all, you need to listen very closely to what I have to say today, and then you might want to do just the opposite, just like my wife and daughters do. That's what that jinx is all about. Anyway, it's great to be here. It's great to be back. My prepared remarks on, as I look at 2025, are really to think big in 2025, you have to think small. Now, before I sort of jump into what that means, I want to give you a quick perspective on the economy and a quick perspective on the markets. And that would be, am I okay? Can I go longer than this? Or I know time-wise, okay. I wasn't sure. Look, from an economic perspective, I think the focus is going to be on the two important trends that we focused on last year, and I think it's going to be the story again this year. And the first is obviously going to be interest rates. And when I look at rates and look at 2025, I think rates are going to continue to go lower. They may go lower slower than what I would have thought. But at the end of the day, you know, from an economic perspective, as you look at interest rates for 2025, it's going to be lower and slower. You know, and as I switch gear and look at inflation, I think that inflation's going to be flat for the first half of the year. But as we get to the second half of the year, I think inflation is going to be lower as well. Maybe a little slower than what I had forecast, but at the end of the day, inflation too is going to be lower and going to be slower. So if you step back from the noise for a minute and think big picture, if interest rates are going to be lower and slower, and inflation is going to be lower and slower, that really bodes pretty well for an economy to grow at above trend growth. I think that's really what we're looking at in 2025, especially when we realize that, you know, 2/3 of the economy is driven by the consumer, meaning 2/3 of the economy is driven by consumer spending. Well, what fuels consumer spending? Lower and slower interest rates and lower and slower inflation. That's going to be the story, in my opinion, from an economic perspective. From a market perspective, I think there's three really important catalysts that are going to be the story of the market, I believe, in 2025. The first is going to be what I will define as robust earnings. I have to, you know, monetize. What does robust earnings mean? You know, it's double digits. I think we're looking at double-digit earnings again in 2025 in our market. So I think that robust earnings is going to be a real key driving force. I think the second key trend in the markets is going to be a round of deregulation across multiple industries and multiple sectors. We're not just talking about one quick cut of one industry. So when you see the synergy that gets created with deregulation across multiple industries and multiple sectors, that too is going to be a catalyst for our market. And then I believe the third trend that's going to happen is I think you're going to see massive corporate tax cuts. So if you think of sort of the big picture of what's out there for the market, and can step back and look at, what that can do as sort of as a catalyst for where we are, it's sort of that combination. If you have robust earnings and you take that robust earnings and you can feed that into the other elements of the market, I think the market continues above trend growth. Look, I know the bull market eventually ends. It always does. It always ends. It doesn't end when you have global disinflation, and it doesn't end when you have global easing. And I think that's what we're going to see in 2025. It will end eventually, but it's not going to end in 2025. So when you look at the potential catalyst of those rate cuts, of the deregulations of robust earnings, combining with the fact that we're going to have global disinflation and global easing, I think it sets the stage for our market to be higher for longer. So if you think about how they play in together, if you have an economy and interest rates that's driven, lower and slower, and inflation lower and slower, it feeds into a market that, as I look at an outlook for 2025, is going to be a higher market for longer than most people think. So with that as sort of a 40,000-foot backdrop, what do I mean when I say to think big in 2025, you got to think small? I think the best value in our market and the best return in our market in 2025 is going to be from the small cap companies. I think John is absolutely positively spot on with his analysis. And when we say small cap or small capitalized companies, we're talking about companies whose valuation in the marketplace is between $250 million or $2 billion. So that's sort of the parameter of those companies. I think that's where the best value is going to be. And why do I think that 2025 is all of a sudden going to be the year that these smaller capitalized companies are going to provide the best opportunity for individual investors? Well, you have to start with the backdrop of what I think is going on in the economy. Lower and slower interest rates, lower and slower inflation, and from a market perspective, we're going to have corporate tax cuts. And then I'll add my wild card that's going to help the small cap companies, and that's the reshoring or the onshoring for inventory. So think about what that means if you're running or looking at investing in a small cap company. They're the biggest beneficiaries of all those trends. The biggest winner is the small companies, which means those small capitalized stocks are really going to have their thing. So lower inflation. So lower inflation means it's going to cost less to buy goods and materials. Well, you would think, well, that should help everyone. But look, it really helps the small companies the best because they don't have any leverage with vendors and suppliers. Okay? When prices are going up, they don't get to negotiate prices. The price is what the price is. So they really have to wait for overall inflation and the overall prices to come down. So these small companies become the biggest beneficiary of the falling inflation because they don't have the leverage that the bigger companies do. So falling inflation is going to benefit them more than it is anyone else. Low and slow interest rates. It's the same thing. Smaller companies are going to be the bigger beneficiary. Think about it. If you run a smaller company, you probably have a relationship with one bank. If you're a big company, you have a relationship with 6 or 7 banks. Why do you do that? So you can play them all against each other. You negotiate for the best rate. You threaten you're going to take your business anywhere else. If you're a small company, you can't take your business anywhere else. You pay whatever the rate they tell you. That's what you pay. So what you're waiting for is interest rates to come down, so overall rates come down, and it provides you that benefit. So falling inflation, lower and slower inflation benefits small cap more. Lower and slower interest rate benefits small cap companies more. Tax cuts. I mean, think of what tax cuts are going to do to the smaller company. I mean, they have the smaller balance sheets, which means the corporate tax cuts are going to help them more than anyone else. It's going to be a great boom to them. It was sort of like us if the executive club gave everyone $1,000 today for coming. Okay, if everyone got $1,000. Whoever is in the lowest earnings group is going to feel the biggest impact of that $1,000. And as whoever in the highest earnings group, it becomes like a rounding error. You really don't care. It's the same with tax cuts for small company stocks. They will be the biggest beneficiaries. And then the fourth and final piece is I really believe what has started and it's going to continue in a very big way is the onshoring or the reshoring of a lot of production, meaning a lot of inventory is going to be made right here. So less potential disruption of inventory. The big winner are small company stocks. Think about it for a minute. Who tends to carry the smallest inventory? It's the small companies. They can't afford to have massive inventory. So as a result, whenever there is a disruption in the supply chain, who gets hit the hardest? It's the small companies. So all of a sudden, if we can look at that supply chain disruption and make it less disruptive by having more onshoring or reshoring here, they become the bigger beneficiary. And keep in mind, when there is a disruption, they don't have any leverage with the vendors or the suppliers. You know, they don't get to call and say, put me at the top of the list, I really need this stuff. No, that's the large cap companies that do that. So, you know, the fact that we're going to have that reshoring that hopefully will help with that, you know, inventory control, I think is a big, big win. So as I look at where the best opportunity is going to be, you know, in 2025, it's really going to be those small cap companies. You really got to think big in 2025. You got to think small, and I think it all ties together. Interest rates lower and slower, inflation lower and slower, the market higher for longer than anyone thought, and best opportunities. John is absolutely spot on, and he's the man you all should be talking to because small company stocks, I think they're going to be the best investment of anything in 2025.
Oh, well, wait, how do you play that? Because here I'm about to ask you, and I think it's the wrong question now this year, so I'm double thinking it. But about the Dow, I mean,
No, it's still the right question. I didn't say it was the only place to make money.
Okay.
I didn't say John's the only smart person in the room. I just said he's one of the really smart people in the room. No, I think the overall, look at, you know, we're going to have lower interest rates, lower inflation, robust earnings. I don't know. I'm thinking the market's probably going to do pretty good.
Could you please put a number on pretty good for the Dow?
Did you know that this is the year of the snake?
No, here we go.
No, it is. It's the
okay.
Chinese zodiac year. I only mention that. It's something to think about. Do you know what the lucky numbers are for the year of the snake?
7?
1 and 8.
1 and 8.
Yeah. And
Oh,
the year
don't
of the
tell
snake.
me.
No, the year of the snake is for financial prosperity. I mean, it really is. You can look this. I mean, you do probably
You didn't make this up.
it now. You know,
It's real.
It is. It's real. The numbers are 1 and 8, and so if you like did the thing, you know, what would 1 and 8 be to the Dow? I mean,
Like
I don't
as
know.
in 18.
I'll just make it. It's 50,000.
What?
The Dow will be at 50,000 by the end of the year. Small cap's going to do great, but the Dow will be at 50,000. It's not that big of a deal. It's only like 18%. It's already been down. It'll be back up before you know it. Yeah, the Dow will be at 50,000. This is not complicated. Rates are going to go lower, slower than anyone thought. That's a good thing. Inflation's going to go lower, slower than anyone thought. That's a good thing. Turn the dang news off. Companies are making money. This is going to work. It's going to be at 50,000. That's for the Dow. Did you have another question?
I can't remember ever being speatless. It's my stock and trade to say something.
There are other questions, though, right?
Oh,
Okay.
yeah, wait,
Okay.
yes. Well, I'll just ask the standard. Could the S&P outperform or underperform, given the technology bias?
No, I think it's going to underperform, actually. I think the Dow's going to be the story. When I say underperform, though, it's still going to have, I think the fundamentals are still there. I think it's still going to have a robust year. I'll define robust year. It'll probably be 6.666. Just easy for you to remember.
Okay. Yeah. All right. How devilish of you. What about the 10-year Treasury?
3.99.
3.99. Okay. So where do you mentioned inflation being lower?
Yeah, I think it'll be
year end?
probably 2.75.
Okay. Any odds of a recession?
Did you ask that question last year, too?
Yeah, I did.
I think you did, yeah. So let me think.
I've got
This
my
is
notes.
always so baffling to me, so odds of a recession. So,
Recession. What did
no,
he wait? What did he
the
say
mall-
last
No,
year?
wait. The malls are packed. The airports are packed. The restaurants are packed. The Amazon delivery lady is on my street 20 times a day. I'm going to go no recession.
That's
I mean,
expensive.
I'm not 100% sure on that one, like the Dow 50,000, but I'm going to go no.
Wait, I want to hear you say this one more time. I just want to make sure the cameras were really rolling. How do we get there to Dow 50,000?
Well, the way you get to Dow 50,000 is interest rates have to be lower and slower. I think inflation has to be lower and slower. I think you have to have robust earnings, and I think you have to have corporate tax cuts. And voila, the Dow's going to be at 50,000.
Amen. Amen. Thank you, Dr.
No,
Bob.
do you want to know about Bitcoin?
I'm going to ask you that.
Okay.
Do you want stand while you're right up there?
I feel so good because no one ever gets to see me because I sit in the chair. I'm so low. I love this little box here. We should do this every year. I can see you all. You look great.
I love it. Why miss this opportunity? Okay, Bitcoin.
Let me tell you something. So I actually thought that the Chicago Bears were going to be in the playoffs this year. No, I'm serious.
Well, we never asked you to forecast the
I'm
Bears.
serious, but I'm dead serious. I absolutely, positively thought the Bears were going to be in the playoffs. Now, I am really glad that I didn't make that bet, okay? Because I was convinced the Bears were in the playoffs. So look, here's the deal. I don't bet on sports, and I don't bet on fake currencies. John's right, man. This is, look at, did people make money during the dot-com? Oh, they sure did, yeah. And did they make money during Tulip Mania? Yeah, they did. They also lost it all.
They didn't keep it.
They lost it all, but that's another story for next year, yeah.
All right, we'll check that out next year.
Thanks,
Thank
everyone.
you, Dr. Bob. Oh, my gosh. Stick with us because we're going to ask a few of your questions. You sent them in. I'm hoping to anticipate a lot of your questions, and then we'll do that, what you're going to do with a $100,000 thing, okay? And we'll be on track, so stick with me for a few minutes. I want to ask you each, and I'll start with you, Diane. What keeps you up at night in terms of, there's a lot's going to happen with the new administration and so forth, but what economic thing or political thing or regulation thing is the thing that could throw a real monkey wrench into your forecasting?
Gosh, there's so much that keeps me up at night these days. I slept about 3 hours last night, so that tells you. Tariffs are something that economists just don't like, but you can't get the tax cuts unless you use the tariffs to pay for them. Unfortunately, when you score the tariffs, they do what's called static scoring, and that means they just take them as a percent of the 3.1 trillion in imports we have. And they don't have any adjustment for the higher prices and the demand effect. And that means you get much less revenues from that. So if we get, I'm only assuming extension of lapsing tax cuts, which is about 4 trillion. If we get as much stimulus as Dr. Bob's talking about, that also is higher inflation instead of lower inflation.
Okay, so tariffs and tax cuts combined could yield higher inflation
Yes.
because they aren't taking into account
Now,
the
in
pricing impact.
retaliation will be, the rest of the world's ready this time. China in particular is ready. And it will be targeted at those longer supply chains that have been used to circumvent through connector countries the tariffs that are
Mexico
out there. It's not just Mexico, it's Vietnam, it's Indonesia, it's Malaysia.
Oh, so you think the tariffs will not be just against China? You're expecting
Well,
them
they're
to hit
worried about the
broadly?
connector countries
Okay.
as well. Now, we don't have We do have a scenario with Mexico in it. The number of times parts go over the border before they become a car, that compounds pretty quickly. And that's something we're really worried about.
You study tariffs. We trade a lot with Canada. You just made the point about Mexico, forgetting Southeast Asia.
USMCA, yeah.
Okay, what, do you believe that the tariffs will actually be applied to this cross-border trade? We import oil, car parts, you're the expert on this. Is that going to happen?
If it does, it is not a good thing. And
Okay.
I think, people say, well, tariffs are deflationary. Why do they say that? Because the last time Congress, which you're now considering, because tariffs, the way you can get these tax cuts through is you have to do it through what's called budget reconciliation. And it's complicated. That means you're supposed to have to pay for it over a 10-year period. So they have to pay for the $4 trillion with some kind of spending cuts or increases, other taxes.
Oh, and they say they're going to get money from tariffs to
Right.
offset, but they're not.
Now, tariffs from executive order do not count in reconciliation.
Sorry, tariffs from an executive?
Executive order do not count in reconciliation. That doesn't mean they might, get a waiver from the Treasury Secretary. But that's why Congress is actually considering tariffs for the first time since 1930. The Smoot-Hawley tariffs, which were done about a year into the Great Depression, were used to, one, penalize, and it was a period of isolationism following World War I, and they're used to penalize. We got in a trade war with 25 countries, and trade globally fell 67%, and it plunged us deeper into the depths of the Great Depression. So that's why economists don't like those things.
Okay, I demand, Margaret, Margaret, we won't be here, but Margaret, we are going to miss Margaret a little bit this year because, as you might have heard, she's going on to other things. But I demand a mid-year, at least a Zoom recap if we have that kind of tariffs, because I want to hear how you recalculate.
And that's what we don't know about is tariffs. Now, what is my biggest wild card for this year?
That's not your biggest wild card?
No, what we just saw in Los Angeles is. The number of billion-dollar extreme weather events. Don't believe in climate change, you don't believe in climate change. But the bottom line is that the number of these massive climate events with destruction has been rising exponentially, adjusted for inflation. And as that continues to rise, that causes disruption in an economy with much less slack that can absorb it less. And it's more inflationary, causes scarcities.
Okay, that's enough.
I know.
I'll be up all night. Now I know why you don't sleep. John?
That's why I don't sleep.
John, what keeps you up at night?
I think that the one thing that sometimes, Warren Buffett often talks about, he's fearful around nuclear arms being used in our world. And I do worry that this potential breakdown in the structure of NATO and how important that's been to our world for such a long time, that's probably what I worry the most about, that a year from now we'll be in the midst of some kind of a crisis around NATO.
Okay, Dr. Bob, tell me it's something like your best batter breaks a leg or something terrible like that. What keeps you up?
I do need a left-handed relief pitcher, but that's not what keeps me
Okay.
up at night. No, I'm a student of history, and when I look at my forecast for this year, it doesn't bode, history doesn't bode well in terms of the presidential election cycle. I'm a big believer in that presidential election cycle that basically says the best time to invest in the United States is the third year of a new presidency, and the second best time is in the fourth year of a new presidency. Well, the third best time is the first year, which is what we're facing in. So I know that there are headwinds from that, and there are headwinds from that for a reason. History is a great teacher. So I wouldn't say that it keeps me up at night, but it gives me pause that becomes an issue, that nothing's as easy as it looks. But for the fact that history is teaching us that, sometimes history doesn't repeat itself. Sometimes it does, sometimes it doesn't. So I worry about it, but not to the point that it changed my forecast.
All right. I was asked for a couple of industries, so I'm just going to ask you to give a one-sentence buzz response. And I think I'll start with you, John, because you probably know some companies in this area, but you could take your pick. But let's start with healthcare. Is this going to be a good year for the healthcare industry?
I think it will be. And I do think that people are concerned about Robert F. Kennedy. It's a lot harder to change this massive ship of our federal government than sometimes people anticipate. So I think that those stocks have sold off and are selling at bargain prices.
Are some of those healthcare companies fall into your small cap portfolio value?
We own names like Charles River, Biorad, locally Adtalem, which of course trains nurses and doctors. They've done extremely well. It's been a long time holding. So those would be some of the healthcare names we like.
Okay. Anybody else on healthcare? Then I'll give you.
I would just concur for two different reasons. I agree that healthcare outperforms. Again, I think the big picture trend of demographics just is going to continue to play well into healthcare. And the other trend is you don't have to invest in it, but technology and the technological advances that we see in healthcare. Those are two overwhelming trends. It doesn't mean that healthcare is going to be a great place to invest all the time, but for longer term trends, when you overlay the demographics of the baby boomers and the technology, I think it's a great buy and hold strategy.
Diane, I'm going to turn to you with housing. Now, we got mortgage rates are up a full % in the last few months. And that adds, I was watching CNBC the other day, $250 more a month in a payment for an average house.
I mean, I said affordability is at a record low. Lance Lambert, who used to be a journalist in housing, has now got his own residential company that he watches the housing market, and he did a calculation of what it would take to bring housing prices back to the affordability we saw in 2019. And it would take a 60% increase in income, or a 38% decline in home values, or a drop in interest rates down to 2.2% on mortgage rates.
So we're
That's-
outpriced. It's impossible.
And what just happened, now the president is elect, and incoming president has said he'll free up federal land for housing, and for a lot of uses. That's part of the deregulation. But the problem is the materials costs, given what just happened with two back-to-back major monster hurricanes. And then you add on top of it what just happened in Los Angeles, material costs, which means you would want to actually be invested in a company that is going to benefit from those higher material costs. But material costs are going to go up. At the same time, the construction, 30% of their workers are immigrants.
Oh, that's getting me to my next thought, but it means you would not want to put tariffs on Canadian wood, plywood,
No,
whatever
but
we import
it's
building.
happened, and it is something I still worry about. You could have targeted tariffs like we saw before on Canada and Mexico. The USMCA comes up for renegotiation in 2026, and if it is not renewed, it was the first trade contract, a trade deal that was set with a sunset clause. And if it is not renegotiated and approved, it will be start in motion the end of the USMCA, which is sort of hard to imagine given that I worked on NAFTA. And I remember you had Laffer here at one point in time, and he said, what an idiot anyone would be for NAFTA. And I actually know NAFTA because I worked on it. And it also has a clause in it that economists can work from Canada in the US. And one of my colleagues is Canadian, so she's here. But it is...
So you think that we have some serious, forgetting the trade issues, cross-border Canada and Mexico. You mentioned a word, but I'm not going to go to you first with it. I'm going to ask you, Dr. Bob, and then we're going to get to our $100,000 question. I was surprised that with all the great favorable trends of taxes and inflation and so forth, does immigration, which is a political word, but it has to do with labor, I know that's your bailiwick, Diane, but does that a big drawback if we do have deportations and of labor that we might need?
Obviously.